Ladies and gentlemen, distinguished colleague, it's a pleasure to be with you today to discuss the next chapter for Europe's capital markets. Our topic is timely. Across the continent, we see renewed momentum to deepen the saving and investment union, reduce fragmentation, and make European markets the natural home from European savings and European innovation. Why reform and why now? Three forces make reform urgent. First, the competitiveness challenge. Too many European companies still look outside Europe for scale, liquidity, and valuation. Second, the investment challenge. Our economies must finance the green and digital transition, which require large, long-dated, and risk-tolerant capital. Third, the trust challenge. Investors expect fair, resilient markets where rules are clear, supervision is effective, and enforcement is even-handed across borders. For me, the objective is simple. Build markets that are bigger, simpler, and safer, without losing the diversity that is Europe's strength. Bigger means deeper pools of capital and more cross-border participation. Simpler means fewer frictions for companies to list, raise follow-on capital, and communicate it with investors. Safer means robust supervision, proportionate rules, and strong market infrastructures that work under stress. 5 priorities to get us there. First, make listing and raising capital simpler for issuers. Streamline disclosure where it adds little to investor protection and focus instead on decision-useful information. Improve the economics of research coverage for small and mid-caps so that price discovery and liquidity can form. Encourage follow-on offerings and secondary listings with lighter, faster processes when risk is already well understood. Second priority, create truly cross-border market plumbing. Settlement, clearing, and data must work seamlessly across the Union. Investors should not face hidden costs or delays simply for crossing an internal border. Consolidated, high-quality market data on price, volumes, and post-trade information should be timely and accessible so that investors can compare venues, cost, and liquidity. Strengthen supervision where risks are cross-border. When risk and business borders are inherently European, think of certain trading venues, clearinghouse, or crypto asset service providers. There is a strong case for more convergence and in selected areas more centralized supervision. This should come with accountability, clear mandates, transparent funding, and rigorous impact assessment. Centralization is not an ideology. It is a tool to solve specific cross-border problems. Hold the line on resilience and market integrity. Fast, fair, orderly markets are not negotiable. That means robust stress testing for market infrastructures, credible recovery and resolution planning, effective surveillance against market abuse, and operational resilience, including cyber, across the trading lifecycle. For innovative segments such as digital assets, the principle is same activity, same risk, same regulation, with proportionate rules that protect investors and preserve financial stability. Keep national expertise in the loop. Europe's diversity is an asset. National authorities know their markets, their SMEs, and their retail investors. Even as we converge, we must keep that expertise close to supervision and policy making. The right balance is European where necessary, local where valuable. That balance builds legitimacy and delivers better outcomes. What this means for market participants? For issuers, expect a clearer path from private to public markets and fewer duplicative steps when raising additional capital. But also expect higher expectation on transparency of sustainability metrics and on treating investors fairly throughout the journey. For investors, anticipated better data, more comparable disclosure, and more consistent supervision across borders. Retail participation can and should grow, provided products are suitable, costs are transparent, and advice is aligned with investor interest. For infrastructures and intermediaries, resilience will remain front and center, both financial and operational. Interoperability, passporting, and supervisory convergence will reward firms that invest in compliance by making cross-border activity more scalable. Innovation will not slow down. Tokenization, smarter post-trade processes, and modern market data architecture can lower cost and widen access. But guardrails matters. Strong governance, fit and proper management, sound custody and safeguarding rules, and effective incident reporting. Europe's credibility will come from consistent application and credible enforcement. As we reform, let us be disciplined about three safeguards: proportionality, subsidiarity, and accountability. Our region can be a bridge for capital flows. Energy transition project and technology venture connecting Europe, the Middle East, and Africa. If we align our listing standards, streamline cross-border offerings, and collaborate on supervision, particularly on market abuse and cyber, we can become a natural hub for growth companies seeking scale and for investors seeking diversified opportunity. To conclude, reform is not about institutions winning or losing. It's about savers and entrepreneurs winning together. If we make our markets bigger, simpler, and safer, Europe can finance its future on its own terms. This is a goal worthy for our collective effort. Thank you for your attention.